Today's episode of the How to Trade Stocks and Options podcast is powered by FinClub and their artificially intelligent stock picks. With nearly 90% accuracy for the first half of the year, you'd be crazy not to try FinClub stock picks while you can. I mean, before they get bought out by one of the big Wall Street banks, because their technology really is that good. So head on over to tryfinclub.com to get nearly $1,500 in bonuses just for starting your free 2-week trial. So join the club, the Fin Club, to get nearly $1,500 in bonuses just for starting your free 2-week trial at tryfinclub.com. That's tryfinclub.com. Hey there, 10-minute traders. Today on the podcast, we're going to cover a bearish strategy called the short call spread. Now, it's also been called the bear call spread or the call credit spread. That's what we're going to cover today on the How to Trade Stocks and Options podcast. This is the How to Trade Stocks and Options podcast, brought to you by 10minutestocktrader.com, where we give you the tools, tips, and tricks to help you trade faster and trade smarter. And here's your host, voted one of the top 100 people in finance by Redwood Media Group, founder and head trader of 10minutestocktrader.com, Christopher Uhl. Today we are going to be looking at a bearish strategy. Bearish meaning we want the price of the stock to go down in value, and that's where we profit. If it goes up in value, we might run into some issues. But if it goes down, hey, we'll be happy with that. Now, a lot of people, when they're first getting into investing, never even knew that you can make money when the stock goes down. They've always been told, hey, I have to buy a stock in order to make money. They don't understand that there is the ability to sell a stock without having owned it. And then on top of that, there's a myriad of option strategies that I like to use whenever I want to see the price of a stock go down. And the one we're going to cover today is the short call spread. Now, there are a few different names for this trade. One would be the bear call spread, and another is a call credit spread. All of those describe the exact same trade here, the short call spread. Short meaning that we are selling this. We are taking in a credit for this trade. If it were a long call spread, we'd be buying it. We would be paying a debit for the trade. But we're going to be selling this trade here. Now, the max profit is what we sell it for, the credit received. The max risk in the trade is the width of the strikes minus the credit received. The width of the strikes being a 98 strike to a 99 strike is a dollar-wide strike. If we take in 25 cents of credit, which I've got listed down here, that leaves our max risk in the trade of 75 cents a share, or $75 outright. And then the ideal setup is high implied volatility. And you want to sell an out-of-the-money call and buy an out-of-the-money call. So the current price, let's say the current price is 96. Okay, we're going to sell a 98 strike, then we're going to buy a 99 strike. A few reasons why we do all that. First reason that we sell the 98 strike is when you look at a call on its own that you're selling, this is the shape of it, right? But it continues to go down like forever. So it has the potential of unlimited losses. The reason we buy the call strike is it changes the direction of this trade and it limits our losses. That's the only reason you buy the call strike. Is number one, to limit losses, and number two, be more capital efficient. Because in this trade, I mean, this is a trade that anybody can do. It's a $75 trade. If you have $100 in your account and that's all you have, you can still put on a $75 trade like this one. So this is a high probability setup, and that helps with the high implied volatility. Because you can sell a trade like this. Maybe this trade has a delta of 25. Delta is an approximation of the probability of it being in the money. If it's in the money, it's unprofitable. But if you look at the other way, a delta of 25 means it has a 75% probability of profit at expiration. That's huge. You're never going to find that just buying and holding a stock outright. Now, that 25 delta may be at 98 today. And let's say it is at a 25 IVR. What is IVR? IVR is essentially your implied volatility rank. That gives you an idea of how expensive option prices are over the last year. So in this case, if it's from 1 to 100, then 25 means that option prices are at the 25 percentile over the last year. So at some point over the last year, option prices were significantly higher than they are in this example today. And we wait for high IVR because if you're selling the 98 at 25 delta, maybe in a high IVR, then you can sell a 99 or maybe even 100 way out here, and you're going to be taking in just as much credit on the trade. And the current price is now, instead of being $1 or $2 away, it's more like $4 or $5 away. So that's why we wait for a high implied volatility on these type of trades, because you can get further away from the current price. You can get further away from the current price, and you take in more credit, so it's making the trade less risky. So the setup here, we're going to sell an out of the money call. So at the money would be here, maybe let's call that 96. We're going to sell this 98 call, then we're buying the 99 call. It's a high probability trade that we discussed earlier. It has about a 75% probability of profit. Now the break-even point is to take the call strike that we sold, 98, and we've taken in 25 cents of credit. So our break-even point is 98.25. So 98 and then 25 cents brings us to our break-even point of 98.25. Now these trades work really well as far as being able to take advantage of the stock price going down. And you know what? If the price goes up to 98.25, maybe from 97, it's still going to be profitable. That's the exciting thing about options. It can go down, or it can go up, or it can stay anywhere in between here, and it still makes money. So that's the short call spread. It's definitely one that I am very quick to use. I really like simple trades. There's no reason to make them overcomplicated, right? Here in this case, if you take this trade here, your max profit on the trade is $25, but your max risk is only 75. 75. So you can get a 33% return on your capital by doing this type of trade. Let me repeat that. You can get a 33% return on capital. Your capital you put up is $75. Your return is 25. That's a third of this. And that's why options trading is so powerful. It's a small trade, absolutely. But there's no reason why you couldn't do 10 of these or 50 of these if that's how you want to put in your account. But it can be a little trade or it can be a big trade. You're selling the call and then you're buying a call to offset the losses. And then you want the stock price to essentially go anywhere down, and it can go up to your break-even point right here, and then it'll still be profitable. I love these kind of setups, but make sure you wait until a high implied volatility rank. That's the real key here. Putting this on and low implied volatility is somewhat of a recipe for problems. Low implied volatility, maybe if this is 97, maybe you're selling this one at 98, or maybe even lower at 97.5. And by doing so, you're taking in less credit, you're getting closer to at the money, and that's just potential problems that you may run into. So there you go. That's everything you need to know about the bearish strategy called the short call spread. Hey, thank you so much for tuning into today's How to Trade Stocks and Options podcast. And before you go, please make sure you like, subscribe, and enable notifications. That way you never miss any of the tools, tips, and tricks that we upload every single week to help you trade faster and trade smarter. And I'll see you on the next episode. Hey, did you realize that you could get the secret weapon that every investor needs right now to start changing your financial future for free? Yeah, that's right. Just head on over to triplestockprofits.com and download your free Triple Stock Profit System ebook today. 10MinuteStockTrader.com content is for information and educational purposes only. It is not, nor is it intended to be, trading or investment advice or recommendation that any security, futures contract, options contract, transaction, or other financial instrument or strategy is suitable for any person. Trading securities can involve high risk and the potential for total loss of any funds invested.
10MinuteStockTrader.com and Christopher Uhl, through its content, financial programming, or otherwise, does not provide investment or financial advice or make investment recommendations. Investment information provided may not be suitable for all investors and is provided without respect to the individual investors and audience's financial sophistication, financial situation, investing time horizon, or risk tolerance. 10MinuteStockTrader.com and Christopher Uhl are not in the business of trading securities trades, nor does it direct client commodity accounts or give commodity trading advice tailored to any particular client situation or investment objectives. 10MinuteStockTrader.com and Christopher Uhl are not licensed financial advisors, registered investment advisors, or registered broker-dealers. Stocks, options, futures options, and other financial instruments not included here involve risk and are not suitable for all investors. You alone are responsible for making your investment and financial trading decisions, and for evaluating the merits and risks associated with the use of any financial security and broker platform. For more information, please visit 10MinuteStockTrader.com/legal. Thanks for stopping by.